Breaking the tax trap: how Americans can legally reduce taxes to single digits overseas. Welcome back to the channel, where we explore cutting-edge strategies to optimize your wealth and break free from traditional financial constraints. Today we're tackling one of the most persistent myths in international tax planning, the belief that American citizens are forever trapped in the US tax system with no hope of reducing their burden. For years, Americans have been told that citizenship-based taxation makes it impossible to achieve the same tax benefits that citizens of other countries enjoy when they relocate abroad. This defeatist attitude has cost countless entrepreneurs and investors millions in unnecessary tax payments. Today, I'm going to shatter this misconception and reveal the legal pathways that can reduce your effective tax rate to single digits, or in some cases, eliminate it entirely. The strategies we'll discuss today aren't theoretical, they're being used right now by thousands of Americans who've taken control of their financial destiny. Whether you're earning 6 figures, 7 figures, or beyond, there are specific legal mechanisms that can dramatically reduce your tax burden while expanding your global opportunities. Understanding the citizenship-based taxation system. Before diving into solutions, we need to understand the unique challenge that American citizens face. The United States operates under what's called citizenship-based taxation, a system used by only a handful of countries worldwide. This means that regardless of where you live, work, or conduct business, the IRS considers you liable for taxes on your worldwide income simply because you hold a US passport. This differs fundamentally from the residence-based taxation systems used by virtually every other developed nation. Countries like Canada, Australia, the United Kingdom, Germany, and France all tax based on residency. If you're a Canadian citizen living in Dubai, Canada doesn't chase you for taxes on your Dubai income. If you're a German citizen working in Singapore, Germany leaves you alone as long as you're not a German tax resident. The American system creates a unique challenge but also opens up specific opportunities that many tax advisors overlook. While other nationals can simply become non-resident for tax purposes and escape their home country's tax net entirely, Americans must work within the citizenship-based system. However, this doesn't mean you're doomed to pay the same rates you'd pay living in Manhattan or San Francisco. The key insight that many miss is that citizenship-based taxation comes with a comprehensive set of exclusions, exemptions, and legitimate planning opportunities specifically designed to prevent double taxation and reduce the burden on Americans living abroad. These provisions, when properly utilized, can result in effective tax rates that rival or even beat what non-Americans achieve through residence-based planning. The domestic limitation approach. Let's start with the baseline approach that many Americans default to, staying in the United States and attempting to minimize taxes through domestic strategies. This approach involves maximizing deductions, utilizing depreciation schedules on real estate investments, timing income and expenses strategically, and taking advantage of various domestic tax shelters. While these strategies can provide some relief, they come with significant limitations. Real estate depreciation requires you to tie up substantial capital in US property markets, which may not offer the best returns globally. Business expense strategies often require you to modify your operations in ways that may not be economically optimal. State taxes add another layer of complexity, and even the most aggressive domestic strategies rarely get high earners below a 20 to 25% effective rate. More importantly, domestic-only strategies keep you geographically constrained to a single market. You're betting your entire financial future on the US economy, US property markets, and US political stability. This concentration risk extends beyond taxes to your entire wealth portfolio, limiting your ability to diversify across currencies, jurisdictions, and economic systems. The domestic approach also tends to involve what I call inorganic behavior, making financial decisions primarily for tax reasons rather than sound business or investment reasons. When you're buying property mainly for depreciation benefits or timing transactions based on tax years rather than market opportunities, you're letting the tax tail wag the economic dog. The Puerto Rico advantage for passive income. Moving beyond purely domestic strategies, the first international option for Americans is Puerto Rico, which offers unique advantages through Act 60. This legislation allows qualifying individuals to dramatically reduce taxes on both passive and active income while remaining within the US territorial system. For passive income investors, those earning money from stock trading, dividends, capital gains, interest, or cryptocurrency transactions, Puerto Rico can potentially eliminate federal taxes entirely. The key word is potentially, because the program requires genuine relocation and commitment to establishing Puerto Rico as your primary residence. The Puerto Rico strategy works because you're technically moving within the US system to a jurisdiction with its own tax authority. However, don't mistake this for a simple address change. Puerto Rico has strict requirements about physical presence, economic connections, and the timing of when assets were acquired. You can't simply relocate and immediately sell a portfolio you've been building for years while expecting zero tax treatment. Success with the Puerto Rico strategy requires spending significant time on the island, establishing meaningful economic connections, and planning the timing of income recognition carefully. For entrepreneurs, business income can potentially be taxed at rates as low as 4%, though this requires setting up qualifying businesses and meeting specific operational requirements. The lifestyle considerations are significant. Puerto Rico offers a unique blend of U.S. legal protections with Caribbean living, but it's still an island with infrastructure challenges and a limited local economy. Many successful Act 60 participants treat it as a multi-year tax optimization play rather than a permanent lifestyle choice, though some do fall in love with the island and stay long-term. The Foreign Earned Income Exclusion Foundation for Americans willing to establish residency outside U.S. territories, the Foreign Earned Income Exclusion represents the cornerstone of international tax planning. This provision allows qualifying Americans to exclude up to $130,000 of earned income per person for 2025, with the amount adjusted annually for inflation. The exclusion applies per person, meaning married couples can potentially exclude $260,000 combined. The provision specifically targets earned income, money you receive for services performed, business profits from active enterprises, and similar work-related compensation. Passive income like dividends, interest, and capital gains don't qualify, but the exclusion can still dramatically reduce tax burden for entrepreneurs and high-earning professionals. Qualifying for the exclusion requires meeting one of two tests. The Bona Fide Residence Test requires establishing genuine residency in a foreign country, evidenced by obtaining residency permits, establishing local ties, and demonstrating intent to remain. This test is somewhat subjective and requires building a case that you've genuinely relocated your life center to another country. The physical presence test offers a more mechanical approach. You must be outside the United States for at least 330 days during any 365-day period. This test appeals to digital nomads and location-independent entrepreneurs who prefer flexibility over establishing roots in any single country. Time spent in international waters or certain restricted countries doesn't count, and you need to be physically present in foreign countries for the qualifying period. Corporate structures and advanced planning. Where the foreign earned income exclusion really becomes powerful is when combined with properly structured foreign corporations. For entrepreneurs earning significantly more than the exclusion limits, foreign corporate structures can capture additional tax benefits while maintaining compliance with U.S. reporting requirements. The strategy involves establishing a foreign corporation in a tax-neutral jurisdiction, countries or territories with zero or very low corporate tax rates. You then employ yourself through this corporation, drawing a salary up to the exclusion limit while retaining additional profits within the corporate structure. Popular jurisdictions for these structures include the British Virgin Islands for simplicity, Hong Kong for businesses requiring more substance, the Cayman Islands for complex structures, and various other jurisdictions depending on specific business requirements. The key is choosing a jurisdiction that won't impose corporate taxes on your business profits while maintaining legitimacy and substance requirements. The introduction of the global intangible low-taxed income provisions has complicated this planning somewhat. These rules generally impose a minimum tax on profits retained in foreign corporations, but with proper planning, the effective rate can be reduced to approximately half the U.S. corporate rate. With current corporate rates at 21%, this means roughly 10.5% on profits above the exclusion limits. Eliminating the corporate tax through foreign partnership. One of the most powerful techniques for eliminating even the reduced corporate tax involves structuring businesses with foreign partners or foreign spouses. If a foreign person owns a significant portion of your business entity, it may be possible to structure the arrangement to fall outside the controlled foreign corporation rules that trigger the minimum tax provisions. This strategy requires genuine foreign involvement in the business. You can't simply have a foreign nominee own shares without real economic substance. However, for entrepreneurs with legitimate foreign business partners, spouses who aren't U.S. citizens, or family members with foreign citizenship, this approach can potentially eliminate federal taxes entirely on business profits. The planning requires careful attention to transfer pricing, substance requirements, and economic reality. The foreign partners must have genuine economic rights and involvement in the business. Simple nominee arrangements or shell ownership structures won't withstand scrutiny and could create serious legal problems. When properly implemented, however, this approach can achieve what many consider impossible: zero federal taxes for Americans earning substantial income from active business operations. The key is ensuring that the structure reflects genuine business reality rather than artificial tax planning. Housing allowances and additional exclusions. Beyond the basic foreign earned income exclusion, Americans living abroad can often qualify for additional benefits that further reduce their effective tax rates. The foreign housing exclusion allows qualifying individuals to exclude additional amounts for housing costs above a base amount. The housing exclusion amount varies by location, with higher-cost international cities qualifying for larger exclusions. The maximum exclusion can add approximately $38,000 to the basic income exclusion, potentially allowing a married couple to exclude over $330,000 in combined income and housing benefits. Additional planning opportunities arise from the interaction between exclusions and standard deductions. Since excluded income doesn't count toward adjusted gross income, taxpayers using the foreign earned income exclusion may still qualify for standard deductions and other benefits that would be phased out at higher income levels. The cumulative effect of these provisions can be dramatic. A married couple each earning $150,000 from a foreign business, with qualifying housing expenses, might find their effective federal tax rate dropping to single digits or even zero after applying all available exclusions and deductions. Lifestyle and location considerations. The beauty of the American international tax planning system is the flexibility it provides in choosing where to live and work. Unlike other nationals who must carefully manage tax residency to avoid being pulled back into their home country's tax system, Americans with proper structures can be more flexible about where they spend time. This flexibility stems from the fact that you're always a U.S. tax resident regardless of where you live. While this creates obligations, it also means you don't have to worry about accidentally triggering tax residency in high-tax countries through extended visits. A German who gives up tax residency must carefully limit time in Germany to avoid being pulled back in, but an American with proper planning can visit the US for extended periods without disrupting their international tax strategy. Some Americans choose the single location approach, establishing genuine residency in low-tax countries like the UAE, Monaco, or certain territorial tax countries. Others prefer the nomadic approach, continuously traveling while meeting the physical presence test requirements. Still others establish homes in multiple favorable jurisdictions, dividing their time between different countries while maintaining their U.S. exclusions. The key is ensuring that wherever you spend significant time doesn't impose its own tax obligations that would offset your U.S. savings. Countries with territorial tax systems, non-domiciled tax regimes, or special programs for international residents often provide the best combinations of lifestyle and tax efficiency. Advanced structures for high net worth individuals. For ultra-high net worth Americans, the strategies we've discussed can be enhanced through additional sophisticated planning techniques. These might include foreign trust structures for estate planning, international insurance arrangements for wealth protection, and complex corporate hierarchies spanning multiple jurisdictions. The highest levels of international tax planning often involve what's called stepping up structures over time. You might start with simple foreign earned income exclusion planning, then add foreign corporations as income grows, then incorporate foreign partnerships or complex ownership structures as wealth accumulates. Estate planning becomes particularly complex for Americans living abroad, as the U.S. estate tax system applies to worldwide assets regardless of where you live. However, proper international structures can often provide estate tax benefits while maintaining income tax efficiency during your lifetime. The most advanced planners often work toward ultimate renunciation of U.S. citizenship, but only after establishing alternative citizenship, optimizing their asset structures, and ensuring they can live comfortably without U.S. passport privileges. This represents the ultimate freedom from citizenship-based taxation but requires extensive advanced planning and isn't suitable for everyone. Banking and compliance consideration. One of the practical challenges Americans face in implementing international tax strategies is the banking and compliance burden that comes with foreign financial reporting. The Foreign Bank Account Report Requirements, Form 8938 filing obligations, and various other compliance measures create administrative complexity that other nationals don't face. Many foreign banks have become reluctant to serve American clients due to these reporting requirements, limiting options for international banking and investment. However, there are still numerous institutions worldwide that welcome American clients, particularly private banks and institutions that specialize in serving international clients. The key is understanding that while the reporting requirements are extensive, they don't prevent you from achieving significant tax savings. The compliance burden is essentially the price of admission for accessing international tax benefits that can save far more than the cost of professional compliance assistance. Working with advisors who understand both the U.S. requirements and international best practices becomes essential. You need professionals who can ensure compliance while maximizing the benefits available through proper international planning. Implementation strategies and next steps. Implementing international tax strategies requires careful planning and professional guidance. The most successful implementations typically involve a phased approach that allows you to test international living while gradually optimizing your tax structure. Phase 1 might involve establishing foreign residency and qualifying for the foreign earned income exclusion. Phase 2 could add foreign corporate structures as your income grows and you become comfortable with international compliance requirements. Phase 3 might incorporate more sophisticated planning techniques as your wealth accumulates. The timing of implementation matters significantly. Some strategies work best when implemented before income reaches certain levels or before assets appreciate substantially. Others require establishing track records of foreign residency or business operations before maximum benefits become available. Geographic diversification should extend beyond tax planning to include banking, investments, and even citizenship portfolios. The most resilient international structures provide not just tax benefits but also asset protection, political diversification, and enhanced global mobility. Conclusion: taking control of your financial destiny. The myth that Americans can't benefit from international tax planning has cost our community billions in unnecessary taxes and missed opportunities. While citizenship-based taxation creates unique challenges, it also provides unique opportunities for those willing to think globally and plan strategically. The strategies we've covered today aren't just theoretical possibilities, they're being used right now by thousands of Americans who've taken control of their financial destiny. Whether you're earning hundreds of thousands or millions annually, there are legal pathways to dramatically reduce your tax burden while expanding your global opportunities. Remember that international tax planning isn't just about saving money, it's about gaining freedom, diversification, and access to opportunities that simply don't exist when you're confined to a single jurisdiction. The Americans who've embraced these strategies report not just tax savings but enhanced quality of life, expanded business opportunities, and greater peace of mind that comes from true diversification. The first step is education, followed by professional planning, and ultimately implementation. The sooner you begin exploring these opportunities, the sooner you can start benefiting from the legal tax advantages available to Americans willing to think beyond borders. Thank you for joining me on Financial Freedom Frontiers. If you found this information valuable, subscribe for more cutting-edge strategies, and remember, your passport doesn't have to be a prison sentence when it comes to taxation. With proper planning, it can be your key to global financial optimization.